Hi, Julie and Brian. Well, if you look at what's happening in the pipeline, what you're seeing in terms of commodity prices are some very serious declines, both from their peaks and year over year now. So that is sort of, we would say that's upstream inflation that is heading towards the PPI and then ultimately the CPI. So we've got gold prices. And in fact, I looked at them yesterday. I had thought that the last 2 years, gold had been trading within the 1,700 to nearly $2,100 range. And that's true. It has, and it has broken down. This is a really good leading indicator of inflation. What caught my surprise yesterday was looking at where gold was in 2011. It was roughly this level. So you can say since 2011, more than 10 years, we haven't had a big burst, a big breakout in the gold price. And that is informing our decision here. Gold is a leading indicator of inflation, and it has not broken out. It is breaking down. And then the second thing that we're looking at is the inventory glut around the world, and especially in the United States. It looks like some of the best supply chain managed companies in the world. Yes, as we're thinking about this question, we compare what Chairman Powell is doing to what Chairman Volcker did in the late 70s, early 80s, when he was fighting an inflation problem that had been building for 15 years. Vietnam War, Great Society, closing the gold window. That was a real inflation problem that built up over 15 years. This inflation problem has been 12 to 15 months by the time the Fed started addressing it. And we think it's much more a function of supply chain imbalances caused by COVID, and then again, by Russia's invasion of Ukraine. These are very, very different circumstances. So what the Fed has done this time around is it has increased interest rates. If they go another 75 basis points, which is very likely on November 2nd, they will have increased interest rates from 0.25 to 4%. And that's a 16-fold increase. What did Volcker do? In the early 80s, he took interest rates from 10 to 20%. That's a twofold increase after consumers and businesses had gotten used to dealing with inflation and working around it over 15 years. This is a real shock to the system. And I do believe we will see the ramifications in many ways. We're seeing housing shutting down. Well, you have to consider the source here. Our focus, our sole focus, is on disruptive innovation. And we also believe that innovation solves problems. We had a tough time going into COVID with our kind of strategy. And then we had a boom in our strategy during COVID because guess what? We needed the genomic revolution to help sequence the coronavirus and figure out tests and vaccines. And our kinds of companies helped with that. We think with supply chain issues and with the food and energy prices caused by this shock, this Russia's invasion of Ukraine, that once again, innovation is going to help solve these problems. Electric vehicles, there's an accelerated consumer preference shift towards electric vehicles like Tesla because of oil prices. And we think there's no stopping that trend now. And in terms of food prices, we do believe that gene editing is going to help us figure out how to produce crops in areas that are less fertile than the Ukraine, the breadbasket of Europe, with less water, less fertilizer, less pesticide. So we're going to continue to see the miracles associated with the genomic revolution. Well, certainly all stocks are experiencing difficulty in this environment as the market tries to understand how far the Fed is going to go and how deep this recession is going to be. So Tesla, as I mentioned, is a solution to the problem. It's very interesting. If you look at gasoline demand this summer in the United States, it dropped below COVID levels, the worst of COVID, And it dropped to levels that we have not seen since 1997. That's real demand destruction. And it couldn't have happened, we do not believe, without electric vehicles at the margin taking huge share from traditional automobiles. So if we had to be concerned about an industry, it would be the traditional auto industry. We think that gas-powered vehicles are going to be obsolete within the next 5 to 10 years. And the traditional auto industry has to figure out a way to migrate into electric vehicles and into the next big phase, which we think Tesla is leading, the autonomous taxi platform phase. So lots of changes here. Traditional industries are in harm's way as innovation pushes through, accelerated by some of the turmoil out there. Well, we are prolific users of Twitter. Ark gives away its research. We give away our research not when it's finished, but as it's evolving. And our most prolific platform, social platform out there, is Twitter. I'm kind of excited to see what Elon will do. I actually think he'll work closely with Jack Dorsey and maybe open up the ecosystem, take away the censorship, make it much more transparent, and I think add more value to that ecosystem.
You don't think that it'll be a mess if that happens? That it'll just be sort of a free-for-all where it's tougher to find commentary of value?
You know what's interesting about Twitter, and we found this, we have a lot of debate around Ark's own strategies. We can filter that debate ourselves. So we can unfollow people if we think there's bad behavior, but that's our choice. And we can follow those people who we think are moving discussions, whether it's about innovation or the economy, moving discussions along. So I think there's a lot of wisdom out there, and we're kind of sick of the nonsense that we see on some of these social platforms. And Twitter, I think, is going to give us more tools to filter out the nonsense and get right down to business. We have a 6-metric scoring system, very much focused on innovation. One of the scores is thesis risk. Thesis risk has a lot to do with government policy. And so in the early days of Ark in 2014-15, we were thinking, okay, government may be very concerned about the safety of autonomous vehicles. But as we've moved through these last 8 years, what we've seen, thankfully, is the government and regulators in particular very focused on data. And what does the data say? The data says that most fatalities and accidents, 85, almost 90% of them, are caused by human error. If we take the human being out of the equation, then we're going to save up to 35, 40,000 lives in the United States, the fatalities per year, and up to 1.25 million around the world.